I've seen, and I'm sure you guys have too, lots of content creators or finfluencers or whatever we want to call them online that seem to think that stocks return 10% or more per year on average. I've seen this on Instagram, TikTok, Twitter. It's everywhere. You guys seen that too? Everywhere.
And your reaction to that is?
Well, so there is some light factual basis for a 10% return. I mean, not light. It's factual or not, I guess, but there's a much larger weight of evidence that suggests 10% is not the return people should be expecting. I think the problem with the 10% figure is that it hinges on the exceptional performance of the U.S. stock market, fine, but also on the more recent history of the U.S. stock market. So it's like, not only does assuming a 10% or whatever, 12% or somewhere in between return require only looking at the U.S. market, it requires looking at the kind of the best historical period for the U.S. market, which I think is kind of crazy.
And this is also the period when so many of today's investors have only had experience with. So many investors arrived in the past 30 to 40 years.
Yeah. Yeah, so I think that's a big part of the problem. Those data are easily accessible, and they're, like the last 20 years, U.S. markets average a little bit below 10% a year. So that's when like a lot of people who are investing today would have would know that data point because they've maybe lived through it or through a good chunk of it. So I think that number, the expected return number, as listeners know, is super important because anyone that's making long-term financial decisions, they need to have some assumption, and decisions are going to be super sensitive to the assumption that people use. So stuff like how much do you need to save, how should you allocate your assets between stocks and bonds and whatever else, should you invest in a long-term portfolio, should you pay off your debt, those are all going to be influenced by the expected return assumption. And like I mentioned before, small differences, like a 1 or 2% difference in your expected return, can totally sway a decisions. So I think it's really important to pin down a reasonable number. And I think it's kind of crazy that there are so many finfluencers or whatever we want to call them online. And I don't want to be mean to anybody, but in a lot of cases, it's people who have very limited formal education in finance and investing. And those are the people that are telling everybody. They're often large audiences that stocks are going to return 10% or more per year on average. Not great.
And a lot of them aren't talking about just entire markets. Like that's their assumption for individual stocks. Like I think the comment that you pulled this topic from specifically, I won't name names, but that individual is a stock picker as far as I know. So the assumption here isn't even looking at a diversified market. It's the assumption that individual stocks should perform at this level over long periods of time, which is even more wild, right? I mean, we've looked at the data on that, and you've posted about it. You posted about it recently, I think. Was it the JP Morgan paper that looked at, was it the Russell 3000, if I'm not mistaken? And it was something like, I'm going to butcher the stats, but it was something like 70% of stocks have seen a drawdown of 60% or more and never reasonably recovered from that, right? So we're talking about a diversified market here, but individual stocks, you absolutely shouldn't expect that.
But think about how dangerous that is from a planning perspective. If you do overshoot the return expectations, it has huge implications, especially over long-term compounding.
Mm-hmm. For sure. Yeah, I would rather undershoot by a bit than overshoot by a bit. Because it's like the idea of compounding, it's you can make adjustments now, but you can't make adjustments later. If you plan for 10% and don't get it, 30 years from now or whatever, that's it. Now I guess you can spend less than you hoped to. Whereas if you're deciding now how much to save, you have a lot more leeway, more levers to pull to affect the long-term outcome.